Palisade Global Investments is pleased to present the Hard Asset Conference on Jekyll Island, with keynote addresses by Eric Sprott and Dr. Edward Griffin, author of The Creature from Jekyll Island. The event will be sponsored by Triumph Gold Corp, currently drilling its 100% owned Free Gold Mountain project in the Yukon, and by Mexican Gold Corp, just weeks away from publishing its maiden resource on its Las Minas Gold project in Veracruz State, Mexico. Come join us at the Jekyll Island Club from October 19th till the 22nd. The event is limited to just 50 participants. Visit palisadeconference.com for more information. Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell, and returning guest to the program today is Daniel Major. He's the CEO of GoviX. Daniel, welcome back to the program.
Thank you, Colin. Appreciate it.
We're intentionally timing this interview just ahead of the Sprott Symposium that we will both be at. Of course, any investors that are at the Sprott Symposium that are listening to this interview, please feel free to come up to myself or Daniel or any other member of either of our teams to meet and to answer any questions that you have. This is a little bit different than what we've done in the past on Palisade Radio. If you're interested in GoviX, or if you have an interest in really diving into the supply-demand side of the uranium market, I think this is something that you should look at because it opens the eyes of investors on just what the deficit looks like for uranium and why we almost absolutely have to hit $60 a pound by 2020. And of course, we could go much higher than that. So we're going to put a few slides up as we go through this. And Daniel, let's start on slide 5 here. And what we'll show on the screen essentially is you've got a red line which shows the uranium price. We're assuming that the uranium price has to go from its current level to $60 per pound in 2020. Then you've got at the bottom, the dark blue area is secondary supply. On top of that is primary production. So that's all the uranium that's currently being produced today and what it would look like just from mines going out of production as the years go on. And on top of that is a charcoal-colored area, and this is what I want you to talk about. This is things that could go into production if they were incentivized by a high enough uranium price, the model here being $60 per pound. And, of course, the last one is that light blue line showing global demand. And this is a pretty fixed thing, the global demand, because we know how many reactors are out there and how many more are slated to go into production. So, Daniel, I'll turn this over to you to try and explain that better than I did.
Thank you very much. Let's just give a bit of background why we've done this first. We announced some time ago that we were appointing Houlihan Lokey to be engaged on providing the long-term offtake for the Madawaila project. We have a project there that's over £2.5 million per annum. Therefore, we were focused on putting floor price long-term contracts into place, which would mean we're talking to the tier one off-takers. As part of any discussion we were having there, we wanted to be able to show how we understood the market and compare that market with those off-takers. So it was very much showing that what we could understand on that market. So what we did, we built a model which has over 50 different assets in it. We worked out what we felt based on public information and where was no public information, that we could find were the incentive price. What uranium price did a project need to bring it into production? So, and then we also applied a factor in there whereby, projects would have to wait to get their permits. So what this model shows is if we put a price deck in, the red line, what it shows under the black charcoal area is what volume of production could be incentivized to come into the market if that price deck were to occur. And this takes it is the most conservative approach. What this assumes is that all management are fantastic, that we all manage to get our financing, debt, and offtake in place when that incentive price happens. And then between 1 and 3 years after that incentive price, based on whether you've got an ISR, an open pit, or an underground, you go into production. So what we're showing here is that the uranium price has got to get up to well over $60 to help the market get anywhere near balanced. And this, again, I say, is a very conservative view. It assumes that everybody's ready, everybody can get their money, and there are no slip-ups on any project. Which I think that's a very conservative approach, Colin.
And what I'm noticing is by about 2023 through to 2025, based on this conservative approach and $60 a pound, you do seem to meet demand, but once again, you quickly fall back into deficit, and that means that $60 a pound probably is not enough to get the production levels up to where they need long-term to sustain.
Exactly right. And I think we should move on to the bar chart that I provided you, slide 6, because I think that shows it a lot better. Because what slide 6 shows you is the gap analysis. So you can see we're in this small surplus that everybody knows about. We very quickly move into a deficit. As you were pointing out, for that small period of time, we'd get a balance, but then we very quickly go back to large deficits. And what you're seeing there, and this is one of the problems that the industry has got, is there are a reasonable number of very small projects, particularly ISR type projects, that can be incentivized at under $60, but their lifespan is so short that they just come in and go out again and actually don't meet the fundamental requirements for long-term demand. So that's really what this is showing. The other issue, and you can see how sensitive this is, if you go on to slide 7, this just adjusts the price by 2 years. And this happens to be the 8 Capital guys' forecast. They saw prices rising to the same $60, but only by 2022. In their particular case, if that was the price deck we used, you actually would never you'd go into a deficit and stay there. So clearly, in their particular case, you would actually expect prices to go higher longer term to be able to maintain it. So what this is really showing is that, and what David Cates and myself and a lot of other guys in the market have been saying is that, the current price does not work. You need a much higher price to incentivize production to come in to fill the increasing supply gap. And that's really what this work has shown, is that even if you take an exceedingly conservative approach and assume that all projects can come online, everybody's ready, everybody's financed, you just fill the market. If there's any slip-ups, there's going to be a problem.
Daniel, if we rewind just a moment to slide 3, I want to go over these maybe obvious challenges to some people, but they're worth noting, and why you keep saying this is a conservative approach, because it's not just that easy to all of a sudden put a whole bunch more mines in production.
No, we broke it down into 4 main areas. One of them is permitting. And I think, the most obvious for this market at the moment is obviously going to be the Canadian projects. We're picking them out because they tend to be the largest ones that would come to the market. But, it's taken between 7 and 23 years to permit a mine in Canada. We've assumed in our model that those projects would be permitted by 2024, so 6 years. So if there was any delay, again, that would make our assumptions very conservative, and you'd see the supply gap just widen out further. The other issue is offtake. We've assumed a balanced price deck here. We've not made any assumption on whether people are fully on full long term or short term. So again, if you are on smaller projects, not the bigger projects, you're going to expect to find that you're working predominantly on spot market, which would tend to push those projects out even further. So your ability to secure offtake is going to be important, and obviously that will turn into how that affects your financing. Obviously, if you're a spot-only seller, your ability to find debt or financing or equity financing is going to be a much greater risk than if you're a major project that can find long-term contract that underpins your debt. You're going to find it easier to find your debt financing to build the project. So, those completely interrelate. And then lastly, there is the construction time where is your project? Do you have all the infrastructure into play? Do you have all the roads? Do you have all the power? Do you have the labor force? So, we've made a very blasé statement earlier about how everybody can just build everything. But the reality is, even when the price moves, that ability to meet the requirements to actually build your mine and go into production are substantial risks still to go through. In our particular case, obviously, we already have 2 permitted projects. We're already working on the offtake arrangements. We're already working on the financing arrangements. Unfortunately, in both of our projects, the majority of the infrastructure and the people are already there.
Therefore, future supply in this model that you've laid out that we've been talking about on slide 5, it's assuming that there's not problems happening on getting future supply in the pipeline, but that's probably not going to happen that easily. But on the other side of the coin, everybody looks for a black swan event, something that can drive the price up quicker, not just based on the supply demand, but maybe an upsetting of the current supply. And you've got a very interesting pie chart here on slide 10 that I want you to describe.
Yeah, this was actually quite interesting. What we plotted here was actually the top 10 uranium producers, where they are today and where we were forecasting them to be at $30. And this assumes still that base case at $60 price coming in. What is interesting is that you think there are a lot of projects. The reality is that the top 10 projects will continue to provide more than 50% of uranium supply to the market. And that is interesting because if we all can remember what happened when Cigar Lake flooded last time, the price went through the roof. So we're not actually changing the structure of this market going forward, or we're not forecasting a change in structure. We are expecting the market still to be fed by 10 projects. So if anything happens to any of these 10 big projects, it will create that black swan event that you're talking about.
So let's step back a second here. $60 is the price that was used in the model. I think that everything's pointing towards having a much higher uranium price in the next few years than $60. $60 doesn't seem to fix a solution or take into consideration any events happening over the next few years on the supply side.
You're absolutely right. And that's why I make the point that right at the beginning, this has been a very conservative approach. We've assumed that everything can just turn up. Every mine can be built. Everything comes in on time. Everybody can finance it. The emphasis for us, obviously, is that our projects can be incentivized in the mid-50s, and we had to be able to prove that to the market, and particularly the offtake side, that our projects were within this scope. I mean, at $50 price, the gap is enormous. I mean, it just shows that the market could never be sustainable, even at $50. And you have to get a price that's well over $60 to start closing the gap in the market going forward. So that's why we took a very conservative approach in our analysis, but I think it does show in a analytical way what we've been talking about in the market, that you have got to see a price increase to incentivize projects to arrive. If you don't get that, the market does not close the gap. And as an example, I provided that one slide on slide 8 that I gave you, which just shows $50. Clearly, if you went to $50, you'd be sitting at a $20 million deficit from 2020 on, from 2025. Well, clearly the market's not going to stay at $50 if, you remain in a very large deficit. And as you pointed out, even on our very conservative approach with $60, you get there, but you very quickly go back into deficit again, a very large deficit. So it is a very conservative approach we've taken. It was really put together to show that this market cannot be maintained. It was important for us that we showed that we could get at least that $60 number for ourselves, because we can build our mines at less than $60 a pound.
Daniel, I assume that you saw the chart that we put out yesterday through Palisade Research, which was simply depicting the URA, which is a global uranium ETF, and it showed that while the stocks bottomed in November of 2016 and then a rally ensued, they had almost given up their entire gains. It's now looking like there might be some renewed interest coming back into the space, and I think Uranium Participation Corp has also edged up a bit, which oftentimes can happen before the spot price moves. So I want to ask you now into kind of current events, a bit on the market and a bit on GoviX. Are you hearing anything in terms of driving the spot price higher? I think a lot of people are under the thought that while the spot price moved up, the utilities never really started buying or signing new contracts a few months back, and that's why the spot price kind of came back down. Is something going to change around that?
I think the important thing that's been happening for me is that you've seen a very steady price increase. The increase in January, it shot off. It was driven by speculation as much as anything else. It came off the back of the Kazakhstan cut. The speculator stepped in thinking, the utility is going to have to rush to the market. They drove the price. It didn't really happen, and it fell away. But I think what has been most important for me is that if we look over the last month, at least over a month, we've had a very steady price increase coming through. We have some ups and little dips down, but we're starting to build a rising position on price, where the troughs are always higher than the previous troughs each time around. So I think we are getting that steady improvement. We have seen a little bit of a tick up in the long-term price. It hasn't happened for a long, long time as well. So the term price has started to show some movement up. It's small at the moment. I think, we shouldn't be surprised. The market is, even we're showing here in all, if you look at UXC and you look at TradeTech, you look at most people's conversation, 2017 continues to remain to a degree of surplus in the market. But we are continuing to hear is that the buyers are getting very nervous about the future. I think all of the conversations that have been had about long-term contracts unwinding are still very valid. And I think this chart shows it. I mean, even on this, we have not assumed, we've assumed that the existing operations carry on. Those existing operations still need to be incentivized. They're surviving on the back of these long-term contracts. And if they can't replace their contracts, you're going to see increasing pressure on the existing producers to close more and more capacity, which then forces the price back up again anyway. I think I'm feeling a little more comfortable about the way price is going up this time around. It's been steady, it's been consistent, and I think this kind of information as well shows that we are looking at a very quick turnaround in the supply deficit coming forward. We've always talked about it. I think what we've tried to show empirically is that it very clearly is going to happen and happen very soon.
Daniel, you've made a great case for the macro reason that uranium is going to have to cross up to $60 a pound by 2020 or 2022, and GoviX, of course, can go into production at below $60 a pound. So the market clearly believes that to a degree. GoviX's share price is well off its low. Obviously, it's sold off with a lot of the rest of the uranium stocks, but held in quite well, and now it seems to be moving back up. So if I was an investor at the Sprott conference next week, I might ask you a few questions like, what do the financing needs look like for GoviX? Should I be buying in the market right now, or do I have to worry about some imminent need for financing? How are you going on the offtake agreements? What kind of news flow is coming?
Yeah, on the news flow regarding the project itself, we're moving steadily forward with the debt side. You can expect us to be coming out and indicating that we've got the letters of interest from a number of banks because they're starting to come in. Those guys obviously have got to go through their due diligence ultimately, and then we'll define the final terms for that. But what is exciting is that, we are getting a lot of interest, as we've indicated before, from the ECAs and the underlying banks. On the offtake side, we're talking to a number of offtakers. They are very much, though, momentum driven, that while we've engaged in conversation, they don't really want to get down to aggressive conversation until they see $30 price in the market, in which case they're happy to negotiate in that mid-50 price for term contracts that we're looking for. So the utilities are wanting to see some momentum as well, and I think the first signs of that momentum are starting to come through. So we're starting to move, start courting each other a little more aggressively. As to the company itself, we keep it pretty lean and mean anyway. So we're certainly good until well into next year. And we have a number of warrants that we'll be looking to have exercised later this year as well, which will hopefully fill up the kitty for next year.
Very good. Well, Daniel, thank you so much for coming back on the program. For any of our listeners that have questions in regards to the presentation in this interview, feel free to leave a question in the YouTube comment section, and myself or Daniel will be sure to respond there. I'll see you up at the Sprott conference next week. Do you have anything else to add?
No, thank you very much. And as you say, I'm there and more than happy to go through this in any detail with anybody at the conference.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?